the trading desk, let me put it to you this way. It's a new Federal Reserve System under Chairman Jerome Powell. It's a new Fed, okay? And by the way, Jerome Powell was a Trump appointee. And why it's a new Fed is what I think is the most important big picture thing going on in the market here right now in global macro markets is that the United States is raising interest rates more and faster than other places, and that's pushing up the U.S. dollar, and that is having a ripple effect across all markets. That's kind of been my framework. I've been thinking that way for the past few months, and that has been the background to all of the trades I make. Before I throw it to Drew, I want to just put in one more plug here for Raul. tv.realvision.com. Please go and have a look at it. You can sign up there. It costs you $180 a year, U.S., and if you don't like it after 2 weeks or during 2 weeks, you can cancel and get out of it. These guys give you great information. Drew, what do you think about my background? It's a new Fed, and that's what really is making the difference here.
I absolutely agree, and this was a big week for us. We had the Federal Reserve meeting on Wednesday. They raised interest rates for the second time this year. We're weighing if they're going to raise 3 or 4 times in total this year. That's affecting markets. It's looking more and more like 4. So again, your new Fed chairperson is really moving ahead with rate increases. But then we also had the ECB meeting on Thursday where they moved towards tighter policy and that they were going to slow and finish their bond purchases this year. But the dovish that sent the euro lower statement that they had was they were not going to be raising rates until the summer of 2019. So that was a little slower than people thought. We thought we might see rate increases sooner out of the ECB. But it was very interesting to see what we had in the U.S. dollar. It had backed off after reaching a high of 95 about a month ago, but we're right back to those levels. We are getting back to possible breakout levels in the U.S. dollar. And as you say, that's a key backbone component of what happens in global macro. And we saw that across multiple asset classes, including gold this week, oil, Canadian dollar. And I'll kick it back to you. I mean, we had a $28 drop in gold on Friday. What do you make of that?
Well, I think it's an extension of what I've been calling the stealth strength of the U.S. dollar. I mean, we're here in Canada. We think of what our foreign exchange relationship is with the United States. But I have seen all around the world, you may have heard of this, places like Turkey, Argentina, Brazil. I mean, it's just almost every currency you can think of, but a lot of what we would call off the run or second tier currencies that you don't notice. We've had this past 2 weeks, the central bank chiefs of both India and Indonesia make very public statements in effect saying to the Federal Reserve, hey, go easy. We're getting killed over here. And the rising interest rates in the States is just having this ripple effect. It shows up in the currency markets and even things like gold. I thought Martin did a great job on that, pointing out that where we could see gold and the U.S. dollar both rising at the same time would be if we get to what he calls the existential crisis in Europe, let's say initiated by Italy. And the existential crisis, picture it this way. It is what we call a contagion effect. You know, all of these markets are linked at the hip, one with the other. And if things start to go haywire, and here's what it would look like, by the way, haywire. If the market thinks that Italy is going to want to renegotiate in any way with Brussels, the market's going to get nervous. You'll see capital leaving Italy. It may go to Switzerland. It may go to Germany. It may go to the United States. But you'll start to get this rippling effect, and that'll show up all across markets. And in that kind of an environment, you could have the U.S. dollar going up as well as gold going up at the same time.
Well, I think that goes back to, again, Martin's point saying, when was the last time we had the U.S. dollar and gold going higher together? And that was during the 2012 Euro crisis when we really thought Greece was going to be exiting the Euro group, or a good possibility of that. And that also ties in with what Raul was saying. He does not think the ECB is going to be able to stop buying bonds. I mean, they are buying all of the Italian bonds right now. If they stop buying them, who's going to buy them? So you're going to see that blowout in spreads between the German bunds and the peripheral European countries. And he doesn't think the ECB is going to be able to follow through with that. So it's almost the two of them really teaming up to say, hey, we could have an explosion in the U.S. dollar if there's this flight to safety. But at the same time, even though the U.S. dollar normally really takes the wind out of gold's sails, we could see both of these moving much higher with this euro existential crisis.
And come back to what Michael Levy had to say about trade wars. I mean, we've seen Canada fall off about $0.015 this week. That is definitely a factor in the Canadian dollar exchange rate. Just the thought that we're not going to be as competitive and all of a sudden our vulnerabilities get shown. And then, of course, there's that thing between Trump and Trudeau. And I wonder, if that was real or if they just kind of did a deal. He said, hey, why don't you say something bad about me and then all the Canadians will like me? Is that possible?
Maybe it was a Father's Day special for him. We just don't know.
Okay, Money Talks all across the Money Talks network. Thanks very much for listening. Mike Campbell will be back next week.